There are thousands of places to put your money, and there are all kinds of investment vehicles. One of the more popular ones is what's called an ETF, or Exchange Traded Fund. The concept of it is simple enough: a basket of securities that trade on an exchange, just like a stock. But are they good investments, though? We'll explore that in this episode of BTB Fusion. What's up, you guys? You're watching BTB Fusion. I'm your host, Derek West. On BTB Fusion, we love to talk about the synergy between business, technology, and personal finance. If tech, personal finance, and business is up your alley, preemptively strike that like button and destroy that subscribe button while tickling the notification bell, so YouTube lets you know when we drop more great content. So what is an ETF? An ETF, or Exchange Traded Fund, is a basket of securities that trade on an exchange, just like a stock. ETF share prices fluctuate all day, as the ETF is bought and sold, distinguishing them from mutual funds that only trade once a day after the market closes. ETFs can contain all types of investments, things like stocks, commodities, bonds, international as well as in the US. ETFs offer low expense ratios and fewer broker commissions than buying stocks one at a time. Like mutual funds, ETFs can own hundreds or thousands of stocks across various industries or be laser focused on a single sector or industry. Some ETFs focus only on US offerings. Others have a more global outlook. There are a multitude of types of ETFs available to the savvy investor that can be used for income generation, speculation, price increases, and to hedge or partially offset risks in an investment portfolio. As an example, bond ETFs could include government bonds, corporate bonds, and state and local bonds, or affectionately known as muni bonds. We talked about industry ETFs which track a particular industry, such as tech, banking, or oil and gas. Commodity ETFs contain holdings in things like crude oil or gold. Currency ETFs have holdings in foreign currencies such as the euro or Canadian dollar. Inverse ETFs short stocks. That is, they sell a stock expecting a decline in value and repurchase it at a lower price. Now that was a lot of financial technical jargon. What does all that mean to you, the individual investor? ETFs provide lower average costs, since it would be relatively expensive for an investor to buy all the stocks held in an ETF portfolio individually. You would only need to purchase and or sell that ETF to own the underlying asset. ETFs that track indices like the S&P 500 are more likely to have lower fees, as there is very little management that would occur within them. ETFs that look at specific industries are more likely to have higher fees, as they need a bit more management. Clear as mud so far? Well, stick with me. I'm getting to the root of the issue. I guess you could say,
well, Derek, that seems all well and good so far. What is all this hubbub about, though?
Well, I guess the controversy begins with the state of the current economy and what could possibly go wrong to cause a recession. If you've been paying attention at all, in mid to late 2019, the talk of recession is thick in the air. There is concern among economists that demand for these funds can inflate stock values and create fragile bubbles. Some ETFs rely on portfolio models that are untested in different market conditions and can lead to extreme inflows and outflows from the funds, which have negative impacts on market stability. Add to the fact that ETFs are thought to have played a major role in the flash crashes of May 2010, August 2015, and February 2018, and you'll start to see why some major players are beginning to say that ETFs are perhaps the next big bubble that's about to pop. Think of housing in 2008 and dot-com stocks in the late 90s and early 2000s. In comes Michael Burry.
Who?
Michael Burry of the movie Big Short fame, who famously called the subprime mortgage crisis and profited off of it, shorting all stocks related to subprime mortgages. In an interview with Bloomberg News, Michael says that the recent flood of money into indexes is parallel with the pre-2008 bubble and collateralized debt obligations. If you don't know what those are, those were the complex securities that almost destroyed the global financial system back in 2008. Speaking to Bloomberg, he mentions the flows will reverse at some point, and it will be ugly when they do. Like most bubbles, the longer it goes on, the worse the crash will be. This, of course, is being picked up by several financial analyst types. Now, Michael makes some good points, and I will concede that it is possible that there is a potential for a significant amount of loss in ETFs. That's true about all asset classes and investment vehicles, however. If everyone pulled out of Procter & Gamble tomorrow, the stock would be worthless, and it would likely kick off a major panic-fueled sell-off across multiple sectors. Same thing with real estate. If everybody decided tomorrow that they'll no longer buy any real estate at all, a ton of banks and a ton of other big financial institutions would fail almost immediately. But the other side to that is that smart money would buy into those investments. Now I digress, as I'm starting to ramble on a little bit here. The question is, are ETFs a good investment? To answer that, it depends. Like any investment, your appetite for risk determines whether it's good or not. That means for young investors, it's an option you should consider. As you get older, you should move out of riskier investments and into investments that will hold value and not necessarily grow at a rapid pace. That being said, here are some reasons why you should include ETFs in your portfolio. Number one, the sheer variety of ETFs available. Back in the 80s and 90s, there were only a few ETFs available that generally tracked the larger indexes like the S&P 500 and the Dow Jones Industrial Average. As of mid-2018, there are more than 1,800 US-based ETFs, according to data from the research and consultancy firm ETFGI. That is a lot of room to make choices. This range of products means that a savvy investor can build a diversified portfolio with a lower outlay of capital than would have been required in the past. Number two, the liquidity of ETFs. The fact that quite a few, if not most ETFs are very liquid is a major plus when considering the other popular stock basket products. Index mutual funds. Index mutual funds are priced at the end of the business day. If you own an index mutual fund that is losing significant value during that time frame, you will not be able to sell it before it loses significant value. The ability to trade in the middle of the day will preserve precious capital. ETFs are generally considered to have lower fees than mutual funds. I'm sure you can find examples to prove the rule, but that is generally the case. You can choose how active you want to be. Because you can choose to purchase ETFs that are more actively managed, or simply choose an ETF that tracks an index, you can essentially choose how passive you want to be. Do you want to pick stocks that try and beat the market? Or you just kind of want to put your money in and hope for the best? Well, with ETFs, you can pick. Now, of course, with the good also comes the bad. We just went over some of the bad points for ETFs in the beginning of the video, so I won't reiterate myself, but as you should know, with good comes the bad. The truth is, ETFs are a good investment vehicle for people who have high risk tolerance, who may not want to invest actively, or who might just want to invest passively while they learn all the finer points of the investing world. If you own any ETFs, be sure to jump in on the conversation and leave a comment on your favorite ones. And don't forget to like and subscribe, and click the notification bell, because up next, we have a video on the journey to billionaire status. Stay tuned for that and more great content from BTP Fusion, and take care, everybody.